index, the overall index, which is a leading economic indicator from the United States, inched up right just a bit above growth neutral. In other words, it had been below growth neutral for 2 months, pointing to an economy that's really slowing down. The growth is slowing down. So this one doesn't change my view on that. This economy, the regional economy, and the national economy will show the same thing coming out later today as well, is this economy is slowing down. Cindy, we're talking about growth for the second quarter was 1.3%. That's GDP growth. Our numbers indicate that for the fourth quarter, which of course we're moving into now, is going to be almost flat, perhaps a 0.5% growth. That is nothing to write home about. And of course, we've got the fiscal cliff coming up on January. This economy is moving into a recession if something's not done about those very significant tax hikes and spending cuts slated to go into effect in January of 2013. So I'm not very optimistic. And speaking of that, the supply managers were not optimistic in our September supply manager survey.
What about the jobs out there?
Even worse, Cindy. The economy, that's GDP, that's the sales, that's the market value of goods and services, that's looking like almost flat. Then you look at job growth. Oh no, we're talking about maybe losing jobs for the fourth quarter. Now we'll have to wait and see, but right now we've been almost flat U.S.-wise and in the region, the United States region, over the last 2 or 3 months. What I'm expecting is flat for the fourth quarter, meaning no job growth for the fourth quarter of 2012. For the region, I think the national numbers are going to be about the same, flat to very small gains.
What about export orders?
Not good. I wish I had some good news here, but everything is looking grim. Well, grim's perhaps an overstatement, but certainly not good. Export orders, the number dropped below growth neutral. And of course, exports are very important. They're not a significant part of the economy, but they're a significant part of the growth of the economy. So when you start trimming exports, which is what we're doing now, that's not good. And of course, we're talking about with the exports, we're going to see that spill over into the economy. We've got Europe slowing down. Actually not slowing down, they're in a recession. We've got Asia, China growth is coming down. Vietnam, South Korea, Indonesia, the list is long. Growth is coming down. We're seeing that in our monthly survey and certainly in our export numbers.
What else about the numbers? I mean, it did go up slightly, but we're not growing?
Not enough, Cindy. The number, of course, the number ranges between 0 and 100. 50 is growth neutral. We're talking about 50 point ... Not much, not anything to make us happy. No one's going to be happy with this report, and the national report that's coming out as well. Not only that, inflation numbers ticking upward. Now that's, of course, the Federal Reserve moved for QE3, quantitative easing 3, which pushes more money out there, more dollars, drives the value of the dollar down. Of course, that stimulates inflation. We're seeing our inflation gauge upward. We asked the supply managers about the next 6 months, how much they expect prices, wholesale prices, to grow. They said 3%. Multiply that by 2, of course, that's 6%. 6% growth. The era of very benign inflation is over, in my judgment. We're going to see it in food prices, oil prices, energy prices. Of course, we economists say, well, if you take out food and energy, it's not so bad. That's not a credible argument. Most Americans, that's where they spend their money, food and energy. So we are going to see that pinch the economy, and that's going to show up in terms of retail sales as consumers spend more on gasoline, and of course less on movie tickets, less on automobiles, less on everything as they spend more on gasoline and energy.
And you talk about durable and non-durable goods and those tied to agriculture.
It is getting tougher. Although on the durable side, durables are looking oddly from my vantage point, I expected the durables to come down faster than non-durables. Non-durables, of course, would include food processing. There's where we're seeing some weakness. Non-durables would include ethanol and biofuels production. Those aren't showing, they're negative in terms of growth. but durables are holding up better than I thought. Agricultural equipment sales still doing well, reasonably well. I don't see that can hold up. I think that's going to come down. Of course, that's going to punch some of the growth that we're now seeing in Iowa, for example, Nebraska, North Dakota, and South Dakota. Well, actually, South Dakota and Nebraska, Iowa, showing some of the pulling that down. Kansas down as well. North Dakota, shining light in the 9-state region. North Dakota and Oklahoma, both energy states, doing real well, still pointing to growth. We're going to see growth in those 2 states, but it's going to be offset by negatives in the other states. Iowa is another state where we're seeing, again, to my surprise, better growth than what I expected. Still pointing to some positive growth in Iowa, which again is surprising. Not quite sure why Iowa's continuing to look more as positive as it is.
Anything else?
Well, I think again the key outcome from our September survey, Cindy, of supply managers in the 9 states is just slower growth, more inflationary pressures, exports looking weaker, job growth not there. So if Congress and the President don't get back to Washington and do something about the fiscal cliff, we're going to see a recession in 2013. I see little chance of avoiding a recession if we don't get some, with these numbers, which is, we're talking about a weak economy, a weak regional economy, a weak national economy, and you lay on top of that spending cuts and tax increases, that's a recipe for recession.